Good evening, everyone, and thank you for joining us. Welcome to Ironwood Wealth Management's Market Insight webinar for Q3 2018. My name is Nick Basso, and I am a portfolio administrator in Ironwood's Asset Management Division. And tonight it's my pleasure to introduce our featured presenter, the Chief Investment Officer here at Ironwood, Mr. Sean Rogers. Sean is a charter holder of the Financial Analyst designation, and he also serves as Ironwood's primary investment strategist. If anyone has questions for Sean during the presentation, please feel free to type those into the chat panel or the question box that is attached to your GoToWebinar panel. I'll compile the questions and we will do our best to address them all at the end of the presentation. And now, without further delay, please join me in welcoming Sean to lead this evening's presentation. Sean, please take it away.
Thanks, Nick. Thanks, everyone, for joining our call today. Even at the earlier time, we moved it up an hour from 5 to 4. Hopefully, that didn't ruin anybody's schedules here. The last two of the last 3 times we've done this call, the S&P 500 has been at 2580, give or take, and previous to the call, we've had some turbulent markets. I'm happy to say that we're not at 2580 on the S&P, and we're not in such turbulent markets, but we do have some things going on. So we're going to talk about tariffs, we're going to talk about earnings, we're going to talk about tech woes, we're going to talk about international woes, and I'm going to go ahead and just jump in here. So once again, I try and keep to a similar topic discussion and go over what we think is really important during these calls. Once again, the global expansion continues. It's not as strong as it was earlier in the year, but it definitely is heading in the upward direction. We'll talk about the U.S. economy. We'll talk about the international economy, everything outside the United States and what's going on there with tariffs. We'll talk central banks. We'll talk earnings, and we'll talk fundamentals. And lastly, I'll leave with the similar slides that I always do, which are more long-term in nature, and so they don't change all that much each presentation. However, we do like to harp on them because they are part of a prudent strategy. So we'll go there. Global expansion. So we're growing. We're above 50, which if we're above 50 on these pop numbers, on these manufacturing numbers, purchasing managers index, it means that the economies are growing. Now you can see that the global economy, green is good, dark green is better. We just posted July's numbers, 52.7 for the global numbers. It's a little lighter than what we've seen previously. We've been kind of closer to 53, 54 the previous 6-7 months. So we do see a little bit of a slowdown, but once again, we are above that 50 number. So that is a positive. The emerging markets countries are definitely slowing. We can see that here in emerging markets down to 51, 52, and they were running a little bit higher than that earlier this year. A lot of that has to do with trade stuff. A lot of that has to do with earnings in those countries have just come down a bit. We're going to talk about that a little later. But on the, if we're looking 30,000 feet level, the global economy is still expanding. The U.S. economy is much stronger. The 10-year Treasury at the end of Q1 was at 2.85%. As of yesterday, when I finished this presentation up and put it into compliance, we were at 3. We've come just below 3 today. So the 10-year Treasuries call it 3%. The ISM manufacturing, non-manufacturing numbers have slowed a bit. But yesterday we got the manufacturing number. It was 58.1, so still in line with relatively strong numbers. Non-manufacturing comes out tomorrow, and we had some pretty strong. We've had some stronger numbers in May and June respectively. So July is we're looking at getting a pretty strong number there. And then also tomorrow we get the jobs report for July. Once again, the whisper number is above 200,000. The market is going to be looking at that, and it should have an impact on the markets tomorrow, especially here in the U.S. We have increased jobs by 200, almost 210,000 jobs a month in April, May, and June, and the current unemployment rate is at 4%. The labor market is definitely tightening. We're at the lowest claims numbers that we've seen since the late 60s and 70s. We've had 172 weeks in a row that weekly claims have been under 300,000. That's the longest streak since 1970. So there's the labor market, to say that it's tightening up is an understatement. It is a strong labor market, and we don't expect it can get too much stronger from here. Demographics would show that folks are retiring and leaving the labor force. It's got a little bit of a skew on wage growth. You know, you're having higher paid workers retiring, and you're having younger paid, lower paid younger workers that are entering. You know, you might be able to hire 2 younger paid workers and replace 1 older retiree to do the same job that the retiree was doing with 2 younger workers. So we've got that dynamic going. Real GDP just came out. Q2, you know, was a very, very positive number at 4.1%. A lot of skeptics were saying that the economy couldn't grow that fast. There's still a lot of skeptics saying that that's mostly due to tax reform, which it is. There's a big chunk of that has to do with tax reform, but we'll dive into GDP a little bit more in detail later on here. We do believe that 3% growth for 2018 is pretty much in the cards. When you get second quarter at 4.1, you get first quarter at 2.2, and you've got, you know, already people estimating over 4 for Q3. The fact that it's very hard to paint a scenario where we're going to drop significantly where we don't get 3% growth in 2018. But in the second quarter, if we look at year over year, GDP growth was almost 3%. It was 2.8% from second quarter last year to second quarter this year. So that's much better than we've seen thus far in the expansion. Length and strength of the expansion. So we've talked about this in the past. I don't want to get too hung up here, but we're on the doorstep of having the longest expansion that the United States has ever seen. But at the same time, when you look at how much GDP growth we've seen and recovered from this big dip that we have because of the Great Recession, we're still not even at some of these lower expansion levels. So yes, it's been a long time, but the economy has not actually improved as much as other expansions. So this picture here is looking at expansions in the economy. It has nothing to do with the stock market. Stock market shows a different story. This bull market has ticked off 316%, and that's just in the price movements of the S&P 500 from March 9th, 2009 until a couple days ago, 316%. And a lot of people get worried about that because we've had these 2 nasty bear markets the last 2 recessions have led to very nasty bear markets, okay? If I look at this 316% and I look at how long this this bull market has lasted, we still have 3 of the last 9 bull markets have lasted longer than the current run. So we're 4 out of 9, well, 4 out of 10 when it comes to bull markets. If I look at price appreciation, so this 316%, there have been 4 bull markets out of the last 9 bull markets that have had more price gain than 316%. So what that tells me is, one, the economy still could have a ways to go before we have any issues. And 2, the stock market may have a ways to go, could have, if we look at, you know, the impact of such a large recession, such a large bear market that we had in 2008, 2009, you would expect a pretty long and robust recovery or bull market to follow that. And so that's kind of the camp that we're in. The other thing I'd like to point out is that because of these last 2 bear markets, one dropping 57% from peak to trough, the other at 49% from peak to trough, I think most folks kind of expect a 50% pullback during our next recession. And that's not always the case. If we look at the last 11 recessions, 9 of the last 11 recessions, we saw about a 25% drawdown. Only these last 2 have been down 50%. And the first one here, the 49% in 2000, we had a forward PE of 27 times. So we're not there right now. We're at 16.5. Valuations are not stretched. This is not necessarily the 1999 dot-com stock bubble. So you kind of throw that one out because you're talking about, gosh, we had 27 multiple. We're not even close to that. And then 2007, you had the biggest financial crisis we've seen in 50 plus years. So those were 2 really, really harsh recessions, and well, I should say really harsh bear markets. We don't anticipate every bear market being that harsh. You know, the 9 previous before these 2, you were looking at about 25%. And we don't know how much further we can go up before that 25 to 50% bear market happens. It will happen eventually. We're not sure when it'll happen. I can just tell you that if we look at history for a guide, we could still have some upside from price and length of recessions. I'm sorry, of expansions, if we just look at the past 9 expansions. So that's what I want to talk about there on that slide. PE multiples, the tax cuts have definitely increased earnings per share. We've had 2 really, really solid quarters of earnings. The next 12 months estimates are at about $170 a share. Current S&P price is about $28.25. So you've got a PE ratio of about 16.6 times. That's about average of what we've seen over the last 25 years. So PE multiples, you know, we're maybe not underweight, or I'm sorry, undervalued. We're not overvalued. We're kind of right in that sweet spot. Given the fact that interest rates are still low, the real yield is under 1%. We could probably make a case that we should be at 18 or 20 multiples. Earlier this year, we were at an 18.5, 19-time multiple. And then we had a 10% pullback in the markets. And so that 10% pullback with in combination with an increase in earnings, really made PE multiples very attractive. And now we've kind of come back to, we're basically only about 2% away from new all-time highs on the S&P 500. But even at this higher S&P number, 28, 25, the all-time number is 28, call it 2875. So we're 50 points away. But that 2875, if we got there today, would be a lot healthier 2875 than it was back in January, because we have 30% higher earnings than we had back in January. So that's another thing to keep in mind. It's not always about prices. I show price here, but really what it is more about is valuations and what are people willing to pay for a stream of earnings. This just shows the earnings estimates and how they've increased with the tax cut. And then actually after we started seeing first quarter earnings, they increased again. And if you look at the second quarter earnings, we've got a bunch of companies. We've got a majority of the S&P. We got over 50% of the S&P 500 companies that have reported already. And we've seen 28% earnings growth year over year. About 7% of that is coming from the tax benefit, but the other 21% is coming from other factors. We still have analysts that are underestimating these things. We have 83% of companies that have reported. They're beating on earnings. So these analyst estimates, 83% of companies are beating these estimates. And so the analysts are having to increase the estimates. And then on the revenue side, we have about 61% of companies beating on revenues. And we've got about an 11.8% profit margin on the S&P 500, which is a very high level, historically speaking. So this chart here just shows, okay, where are we domestically, the S&P 500, where are we when we look at several different valuation metrics? So there's several valuation metrics. There's the PE, the Case-Shiller, dividend yield, price to book, price to cash flow, and then the earnings yield spread. And then we say, okay, compared to our 25-year history, how much are we over or undervalued? So the PE would say we're right about fairly valued. The Case-Shiller, which is a little harder one to look at because it's looking backwards, it would say that we're almost one standard deviation above value domestically. Dividend yield, right about average, right about on par. Price to book, right about on par. Price to cash flow, it says that we're overvalued a little bit. And then the earnings spread says we're undervalued a little bit. So you take all those into consideration, and maybe we're fairly valued, maybe we're a little bit overvalued. With low interest rates, we could probably make an argument that we're probably more fairly valued than overvalued if I had to make a case for one of them. Why are valuation metrics so important? Well, they're not really that important over the short run. It's very hard to predict what stocks are going to do no matter what metrics you're using over the short run. This chart on the left, it's a scatter plot. It just shows forward PE and the subsequent 12-month return. So the next year, if I tell you what the PE multiple is, then we look at, okay, what's the next 12 months of return? You can see there is no rhyme or reason. They're all over the place. Yeah, it's got a little bit of a regression, but for all intents and purposes, all these plots are everywhere. If we look at PE ratios, and then we say, okay, what's the next 5 years average annualized return for the S&P 500? Now we have a much better regression analysis, and we've got a much better conviction on saying, okay, at the current, well, this chart's a little old, but at the current 16.5 PE multiple for the S&P 500, for the most times we're gonna end up with a positive 5-year annualized return in that type of an environment. Okay, that's why when we look at our 10-year and 20-year projections on what asset classes are going to do, valuations are very, very important because they do give us a sense of where asset classes are headed longer run. Job market, like I said, it's very tight. Wage growth is still being pretty pesky. Unemployment rate is 4%. We get a new number tomorrow. I'm sure the market will be moving on that. Really would like to see this wage number go up a bit because after you put in inflation, really real wages are not moving anywhere. Inflation right now is right around 2.8% as of the last read we received. And so really what this is saying is that wage growth has been flat. And that's not the greatest thing, but there are also some demographic things at play here. Like I said, people with higher jobs are retiring, and then younger folks are coming in, so they're just getting paid less, and it's having an impact on some of these gauges as well. If we look at the Atlanta Fed, they have a different way to track wage growth, which I think is a better way to look at it. It's actually at 3.2, so it shows a little bit better picture, but still, we'd like to see that number a little bit higher. Cyclical sectors, not much has changed here. Light vehicle sales came down a bit, but they're still more than their longer run average. Inventories came down a bit, but are still a little bit high. Real capital goods orders continue to go up. We see that this will continue to go up as the tax changes, as we're able to expense items, and as companies are earning more profits, they're going to spend some of that to buy CapEx spending, real capital goods orders. And then housing starts have slowed a bit. The housing market in general has slowed a bit. We've got increased interest rates and mortgage rates, and then you've got real wage growth that's not really growing, and so prices have gone up, interest rates have gone up, wages have not necessarily gone up in line with those other two things, and so affordability it's still we're still in a market that's pretty affordable, but you're starting to see some of those houses just being those buyers being priced out of the market. So housing definitely, the last couple months, we've seen a little bit of a slowdown there. Consumer finances, still similar story. Net worths are at all-time highs. We've got actually $7.5 in assets for every dollar in liability we have. So that number's been going up each and every quarter. And then a majority of that debt that we do have is mortgages, which is not necessarily a horrible debt. Like I said before, household debt service ratio is still at 10.3%, but you can see it has gone up a bit. And as interest rates continue to rise, you'll see that household debt service ratio continue to rise as well. Same with prices on existing homes and new homes. Federal finances, there's a lot of questions on whether we needed this tax stimulus when the economy was running pretty well. It definitely has a boost, and the bigger question is, will this growth, can this tax cut, especially on the corporate side, can it create 3% GDP growth indefinitely? Can it increase our workers' productivity, or will we be stuck at the 2.2% that we've had over the previous 8 or so years before 2016? So that's the ultimate question. Two of the largest pieces of the federal budget, Social Security and Medicare, these programs need to be fixed. They represent, obviously you can see here, 50% of the budget is Social Security and Medicare. We have an aging demographic. We have people retiring in mass amounts. We need to figure out these programs. These two programs are a huge part of the federal budget, and we need to make sure that those two programs are solvent and that we make small changes early versus having to make larger changes as we approach 2025 to 2030-ish is about when those two programs start having some issues. So those are going to be some things that are going to have to come up on agendas here. And if you're planning for your retirement, if you're planning for your financial outcomes, the writing is kind of on the wall that some of these things are going to have to change over the next 7 years. While we have the tax laws that we have, I would probably be taking advantage of them if you can. I'd probably be looking at Roth conversions because I can't really see taxes getting much better than they are right now because of some of the things that we see with federal finances. But if the economy can grow at 3+ percentage points, some of this won't be an issue. You can see that the CBO is looking at about 2.6% growth in 2019, 2020, 1.5 2021, 2022, and 1.7 2023, 2028. So if we have 3% growth or even 2.5% growth, these numbers are going to look a lot different. The accumulated deficits are going to look a lot different. So I think this one is still up for debate, and it's definitely one we want to keep an eye on, but it's more longer term in nature. Economic growth, like I talked about, quarter over quarter, we had 4.1% GDP growth. That's the highest number we've seen since 2014. Year over year, 2.8% GDP growth, and then the average during this expansion has been about 2.3. So both those numbers well above the averages that we've seen over this expansion, and we could paint a picture where we continue to see some of that. Now, a lot of folks are arguing that most of that came from tax cuts. Yes, some of this came from tax cuts, but if we even dive deeper and we look at something called potential GDP growth, which is looking at GDP growth and taking out the impact of unemployment improvements. So basically, the fact that over the past year the unemployment rate's gone from like 4.3 to 4%. If you take that benefit out to GDP and you look at the real GDP potential, you can see that it's gone from about 0.6% during the majority of this expansion to over the last year it's gone to about 2%. So to me that's a sign of this economy is more than just tax cuts. It's actually showing some signs of other things happening as well. International. I'm going to start with tariffs. I know everybody wants to know, how are tariffs going to impact the stock market? Well, it depends. It depends on if these, so maybe if I take a step back, tariffs are bad for the global economy. They will, if a year from now we have more tariffs than we have today, we will have lower global growth than today. If we have more, if this is rhetoric and negotiating and we actually have less tariffs a year from now, then global growth should be higher than otherwise. So it really depends on the administration and if they're in the camp of really going through with more of a trade war than a negotiating tactic. No one knows exactly what's going to happen, but and really the EU, Mexico, and Canada, it sounds like things are headed in the right direction with those three countries, or I'm sorry, the EU, not a country, but the zone. It sounds like the United States is coming to agreements with those three areas. Where we still have some tiffs and some trade war antics going on is with China. And so what the administration keeps touting is we have a huge trade deficit with China. And so they keep talking about, so this is the U.S. trade balance. We export into China, a little less than 200 billion. They export to us, about 500 billion. So the net is right around $400 billion of net imports into the United States in this case, or a trade deficit to the United States, a trade surplus to China. And so the United States, the administration is using this as a leverage tool to put tariffs on this big amount, and China can only put tariffs on this smaller amount, and therefore, the thought process is we can put them through a lot of pain and then end up with more reciprocal, more free and fair trade. If you take the administration at their word, that's kind of what they're doing. Some people agree with it, some people don't agree with it. If it ends up with higher tariffs, it's probably bad for the global economy. If it ends up with less tariffs, it's probably good for the economy. Until we know what the outcome is, we just need to be aware of it and know that it's created some opportunities. Emerging markets are all big exporters. So when this news comes out, emerging markets do poorly, and emerging markets have underperformed domestic about 10% in the last 12 months. Developed international has also underperformed the S&P 500 as far as stocks go by about 10% in the last 12 months. Not all of it's due to trade, some of it's due to lower revenues, but you can see, a lot of folks are asking, well, how does that impact the United States if we get into a trade war? Well, if it's just with China, then we're looking at very, very minimal impact to GDP growth. But it doesn't mean that that it won't lead to a domino effect, and then that people's emotions will get the better of them, and they'll start just selling emerging markets, which will then, make people sell domestic. I mean, you could just get a massive, we don't want to deal with this right now. We're going to bonds, we're going to safer assets, and we're going to sell anything aggressive. And I don't think that it would get to the level of 2008, but when you have these things that come into the market, emotions play more into it than actual impact. The actual impact of China to the U.S. is very minimal, but where that ends up going is very hard to predict. But that's kind of where what we see when it comes to tariffs is realistically it shouldn't be that big of a hit, but emotionally it could always get worse. Global GDP actually looks fairly strong at about 6.2%, the highest in 6 years. Corporate profits usually follow that GDP, and they have, and we've seen that. And once again, stock prices usually follow earnings. Europe, if we just take a look at Europe, Europe is definitely in an expansion. They've slowed a bit, but they're about 2 or 3 years behind the United States when it comes to expansion. They went through a double dip recession, and they finally got to some pretty good growth. We're slowing down a little bit, but we're still growing at a pretty good rate, and their unemployment rate's still coming down. So Europe looks good. We believe in international, not only because of what this slide shows, but because of valuations and because ultimately what it comes down to is you never know what period you're going to be in. And if it were the mid-'80s and you didn't have very much international exposure and international outperformed domestic by 374% in 6 years, I'll bet you'd be kicking yourself for not owning a little bit international. And over the last 9 years, if you had all international and you didn't have any domestic, and domestic outperformed international by 86%, you'd probably be kicking yourself for not owning any domestic. And unfortunately, we have no idea which one of these is going to end up happening over the next 5 or 10 years. What I can tell you is that it appears that international stocks are a better buy because of the prices people are willing to pay for the earnings streams compared to what they've been willing to pay over longer periods of time. And then you just look at this chart and you say, okay, international outperformance for a period of time, then domestic, and international, domestic, and so on and so forth. Last year, we started to see international outperform. It's had a little bit of a hiccup here with some things going on with tariffs, and so now it's actually underperformed. But you can see that not all the time does it start off and just go gangbusters. Here in 2001 time frame, we had a little bit of negative, and then it took off and outperformed for a 7-year period of about 65%. So it could still be one of those. You know, we look at 10, 20 years out. We look at price to earnings multiples. We look at all kinds of valuation metrics. We look at dividend yields, and international looks attractive on many levels. So we definitely want some exposure, and we actually, in our last rebalance, we've increased our international exposure and we've decreased our domestic exposure even more so than we had before. This is just another slide to kind of show this. The last 20 years, people have been willing to pay about 15.9 times earnings for the S&P 500. It's 16.5, so it's a little overvalued if you look at versus the last 20 years. Dividend yield, 2%. Dividend yield over the last 20 years, 2%. So I'd say if you look at this grand scheme of things, we're about fairly valued on the S&P 500. If we look at international ex-US, we look at all country world index ex-US, 13.2 is the current price to earnings multiple. People are not paying what they historically have paid, which is 14.3 times in the last 20 years. And also, you're getting 3.3% dividend yield versus what you have gotten over that 20-year period, which has been 3%. So that just shows that, yeah, there's some blood on the street. International hasn't done well. We've got tariff talk. We've got central banks outside the United States still in easing mode. There's a lot going on. But when you look at the valuations, when you look at where can we put money for the next 10 years, I would rather be putting it in international versus domestic. Now, that doesn't mean that we've gotten rid of all of our domestic. It could still be a period of time where we're 5 or so years into this 6.2 years of domestic outperforming international by 220%. We don't know, and that's why you never abandon any one asset class. You just might change your allocation slightly to take advantage of what you think might be under or overweights. Central banks, not much has changed here since last quarter. Rates have gone up. As of yesterday, rates, the 10-year Treasury was at 3%, putting the real yield at about 0.75%. We've had a bull market in bonds for the last 37 years. You can see that we've had like a little trend reversal here, and if we continue to go higher and break some of these earlier levels, we could be at a lot higher rates than we are now. And we just want to make sure that we're cognizant of that. The Fed still has a giant balance sheet. They have some control over the balance sheet. Basically, we're in the third quarter of 2018, they're going to be getting rid of $40 billion per month, and that's up from $30 billion per month in the second quarter, which is up from $20 billion per month in the first quarter. They're getting rid of $40 billion per month of their balance sheet by letting some bonds mature and fall off the books. In the fourth quarter, they're gonna increase that from 40 to 50, and in 2019, it's going to be $50 billion a month every month. So they're going to get rid of $600 billion in 2019. So that's where we see this forecasted reduction in the balance sheet. So that's going to tighten bond markets, which means rates probably will go up as they do this. And then also, they're going to be increasing rates. We have some counterbalance. So that was the United States Fed. We still have central banks that are outside the United States. The Fed is not the only player. And you can see the Fed has begun tightening. The Fed is the gray line. Below this, they're tightening. They've been tightening. They're going to continue to tighten. But you can see the Bank of Japan, the European Central Bank, the Bank of England. Well, the Bank of England's done tightening, but they're not. I'm sorry, they're done loosening. They're not tightening either. But you can see this total. When you add in the Bank of Japan and the ECB, we still are in, even though we're in 2018 here, we're still in easing mode. We're in expanding mode when you look at all central banks. However, in 2019, that will change. You'll start to be where we have negative. We're no longer expanding balance sheets of central banks. We're contracting balance sheets of central banks. So another item that we want to be aware of. The yield curve has significantly flattened since Ben Bernanke announced the taper program. So you can see that in December 31st, 2013, we had a pretty steep yield curve. And now, as of June 30th, it's pretty flat. And if we look at 10-year minus the 2-year, it's about 30 basis points, 0.3%. That means if you buy a 10-year treasury, you're only going to be compensated 0.3% per year more than a 2-year treasury. I'm not sure many investors are going to want to do that. Some international investors are keeping that rate down because the international rates are so low. But like I said before, the Fed has a pretty big balance sheet, and they can control both the short end of the curve, and they have some control over the back end of the curve. They do not want to see, in my opinion, they do not want to see this curve invert. And I think they're going to make sure, do everything in their power to make sure it doesn't invert. But it is down to 0.3%. And so we want to make sure that we keep an eye on that. As interest rates go up, realize that that's a net positive because we have household interests of about $1.4 trillion of income coming in from income-producing assets, money markets, short-term bonds, versus we have expenses of about $350 billion that are tied to interest rates. So as interest rates increase, that income number is going to get a lot bigger faster than the expense number will get. And then also keep in mind that when a 10-year treasury is below 5%, it has a positive correlation with stocks. So as long as the treasury rate, the 10-year treasury is below 5, which it is, it's at about 3% now. As it goes up, stocks usually go up. Once it crosses 5, then that relationship breaks down. Seeing, why are you talking about this flattening yield curve, and why is it so important, and why do we not want to see an inverted yield curve? The reason we don't want to see an inverted yield curve is about 50% of the time that we've seen an inverted yield curve, it's foreshadowed by about 6 months to a year a recession. It means that the long bond is paying less than the 2-year bond, which just means people expect lower growth going forward. It is basically what it's predicting. I think there's a lot of noise right now in this metric. I'm not so certain that it's as reliable as it has been in the past because of the Federal Reserve's balance sheet. However, even with that said, it's definitely an item that every single day when I wake up in the morning and I look, one of the first things I look at is what's the 10-year, what's the 2-year, where are they at, what's the spread, is it getting closer, is it expanding, where is it headed? That's one of the first things I look at every single morning. What is the Fed going to be doing over the next year? This just shows Fed expectations. You can see that the Fed expects to hike rates in September of this year, December of this year, March of next year, and June of next year. Give or take, that's 4 more rate hikes in the next year. That puts the Fed funds rate at 3% in the middle of 2019. So, you know, right around here is where we would see that, which is kind of in between what the Fed, what their dot plots say, and what the market expects. But if we're right and we have 4 rate hikes between now and June of next year, interest rates are going to go up. Probably the 10-year goes up, absorbs about half of that, so it goes from 3 to maybe 3.5, maybe 3.75, and then the shorter term Treasury maybe absorbs about 75% of that, so it goes from 2.6 to call it right around 3.5. So you've got basically a flat yield curve, but I really think that depending on where that long bond goes is going to dictate, you know, if the Fed does 3 or 4 rate hikes, because they're really not going to want to see an inverted yield curve. Why are interest rates so important? Interest rates are very important because our bond portfolio is highly dictated, that the returns we see from our bond portfolio are going to be dictated by what interest rates do. As interest rates increase, your bond return your bond price will go down. As interest rates increase, bond prices go down. So over the past 37 years, our interest rates have gone down, meaning bonds have had a bull market. Prices have gone up, and bond investors have done very well on a risk-adjusted basis during the last 37 years. If over the next 10 years we're in an increase in interest rate environment, bonds probably are not going to give us the best risk-return relationship or return, but they're also not going to kill us either by holding bonds, and they're going to give us some income. So if our 10-year Treasury is 3% today, a year from now, it is quite possible that the 10-year is close to 4. Let's just call it 4. Let's say that the 10-year interest rate increases by 1%. If that happens, then, and you hold the U.S. aggregate bond fund, you're going to see about 5.9% price drop in the U.S. aggregate, in all the bonds that are in the U.S. aggregate. But you're also going to see about 3.3% in annual yield. So 3.3% positive and negative 5.9% in the negative direction leaves you with a annual return from the U.S. aggregate. If rates went from 3 to 4 over the next year, you would earn a negative 2.6% in your bonds. Okay. Now, a bad year in bonds is a bad day for stocks. So even if bonds do horrible, it's not going to be to the extent in which stocks can hurt you. So you need to make sure that you really have an appropriate amount of fixed income in your portfolio, because it's one of the only asset classes that has a zero and sometimes even negative correlation to stocks, and that is very important. You can see here correlation to the S&P 500, negative, tips are close to zero, negative, and then as we get into some other of these bonds, you start to lose some of that relationship, but you still have some low correlations in mortgage-backed securities. The broad market is about zero, municipals about zero, and corporates, 0.35. Not hugely correlated, but you get the picture. We need something in our portfolio, especially if you're getting close to retirement or in retirement. You need something that's going to be there in case a recession happens. And that is why we have bonds in the portfolio. But our base case scenario is interest rates go up from here, stocks go up from here. That diversified portfolio, yes, you don't make as much money in your bonds, but you make up for it in your stocks. Okay, sticking to fundamentals, these are the slides that kind of stay similar. We want to take a look at cash. Cash is paying us a little bit more. If we've got an online savings account, maybe we're getting 1.5%. You're still not keeping up with inflation when inflation's over 2.5. So it's not a good long-term investment. You can see that we're holding, the U.S. is holding a lot of cash, $15.9 trillion, which, just to give you an idea here, is more than the amount of consumer spending and more than the entire mortgage debt that is outstanding. So we're holding a lot of cash, and it's not paying us a lot. We can't do that for a long period of time before folks need to earn something with their money. So we see that as a tailwind to the market as people forget 2008 and start to deploy cash in, let's say, bonds, and then start to deploy bonds and maybe stocks. And that could be, what drives another couple of years in this bull market. Another thing that we like to look at is our S&P 500 earnings yield. You can see that it popped, and that's due to the increased earnings estimates, which reduced that price to earnings multiple. So you still have a big relative to fixed income equities. Even the S&P 500 looks a lot more attractive versus if we go back to the stock bubble of 1999-ish time frame. Bonds were yielding about 8%, but you couldn't get people to buy bonds when they were yielding 8% back then, because in the late 90s, the S&P 500 averaged over 30% per year for 3 years. So people were saying, well, why the heck do we want bonds that are paying us 8% when the S&P 500 is going to get me 30+%? Well, that happened until then it dropped by 49%, like we saw on the previous slide, where if you had some bonds in your portfolio, they would have done very well during that period of time. And so, when you have a gap like this, bonds are more attractive than stocks. When you have a gap like this, stocks are more attractive than bonds. And right now, we still have a gap that would show us that stocks are more attractive than bonds. Earnings look very good. Forward estimates look very good. Corporate profits are at one of the highest levels we've seen. They're not passing that better profit on to employees. As the job market gets tighter, we think that they're probably going to have to do that. So we think that some of these profit margins are going to go down. One thing that I do want to mention here is that corporate stock buybacks have increased by about twice as much as they the announcements have increased about twice as much as they were last year at this time. So companies have opted to put a lot of that profit back just by buying their shares, which is later on going to increase earnings per share because there's going to be less outstanding shares. So that's not necessarily a bad thing to be doing. You know, instead of having the money sit on their balance sheets, they're just putting it back into the company. The other thing that they're going to do with that money is they're going to either pay down debt, do some CapEx spending, or send it out to shareholders as dividends. We think all of those are good uses of money, but we have seen that companies have definitely looked at corporate buybacks over the last couple months for a big chunk of that, which is just going to improve future earnings, which is then going to bring down our price earnings multiple or create the stock or cause the stock market to do better. So once again, if we're looking at price to earnings multiples and we think that the earnings are going to be better later on, earnings are what drive long-term stock market prices. So earnings per share, if we have less shares outstanding, by them buying that stock now, it's going to increase earnings per share later. I'm going to just stick to valuations over here. Once again, valuations, this is just looking at valuations in more than just a price to earnings multiples, but looking at price to book as well. U.S. fairly valued, 25-year average is purple, current is blue, and then we've got the 25-year range. So you can see it's right in range. You can see that domestic or developed international is undervalued. Europe is undervalued. Japan is significantly undervalued. Emerging markets is undervalued. Just different ways to look at valuation metrics compared. I'm not going to spend a lot of time. We're kind of coming close to time here. We just want to make sure that folks are not too domestic biased. Yes, we live in the United States, but there's a big chunk of global GDP, global growth that resides outside the United States. We want to make sure that we capitalize on it. Commodities are always a good thing to have in the portfolio. Once again, they're a lowly correlated asset. If inflation picks up like it has, commodities should do well in an environment like that. Commodities have not done well over the past 4 or 5 years. At some point, they will have their time. It's good to have a 5% or so sleeve of commodities in the portfolio to help with rebalances and to give us that lowly correlated asset to add into the portfolio. We don't necessarily want to get rid of bonds. If we were to have invested $100,000 in 1998 in a 60-40 portfolio, 60% stock, 40% bonds versus the S&P 500, you can see that the 60-40 portfolio starts off, it just doesn't grow as fast as the all-stock portfolio in the upturn. But then stocks take it on the chin and lose 49%. The 60-40 portfolio only has about 9,000 less than what you started with. So you've got a lot smoother ride with the 60-40. You don't have as big of ups, but you don't have as big of downs either. And over a 20-ish year period of time, you end up with almost the same value here. So bonds do reduce the volatility we see in our overall portfolio, and they over this 20-year period, yes, we have a little less in the portfolio than we would have if we had all stocks, but is it really worth your portfolio being worth 30% less than what you started with 10 years prior? If you were looking at this thing February 27, 2009, and really the reason that we're so concerned with that value is people tend to start to make bad decisions when they look and they say, gosh, I invested $100,000 and 10 years later, I have $71,000. This is not working. And so they make some bad decisions here. when if they would have just held on, they would have gone from $71,000 to $310 over the next 10 years. So it's all about having the right time frame and just making sure that you have a disciplined approach and you have a portfolio that fits your risk tolerance willingness, and that also fits your ability to take risk. I had a client the other day, ask me about what we should do with some money that they had, and she wanted to know what a safe return was, and I said, well, a safe return, everybody has a different definition of safe. And I said, really, what we want to look at is what are you doing? What is the goal of this money? If we've got 10 plus years, well, this is holding periods and S&P 500 returns. Were the returns positive or were they not? And you can see that if we have a 1 month holding period, 60% of the time we make money, 40% of the time we lose money. We're not in the game. We're not in this to lose money 40% of the time. If you've got a 1 month period, you should not be looking at stocks because you're not putting the odds in your favor. If you even have a 1 year holding period, 75% of the time we made money, 25% we lost money. That 25% comes with some big losses. If we've got a 1 year holding period, we do not want to look at stocks. If we have a 5 year period, now we're at 90%, but still we're looking, when the 10% of times we did lose money, we lost 10%, 5%. We lost quite a bit of money. So even 5 years, I would say stocks probably are not the right investment choice. When we go to 10, now we're at 97, and the two times we've lost money over a 10-year period, it's not been a lot of money. One of the 10-year periods was this 98 to 2008. Okay, so not a big deal there, but as long as we have some other asset classes that did perform well there, then we were okay because we weathered that storm. And then 15 years, there has not been a single 15-year period. 73 out of 73 times we have had positive growth from the S&P 500. So it's all about your time frame. And just because you're retiring in 5 years doesn't mean that your time horizon is 5 years. If you retire at 60, you could have, and you're 55, your time horizon, if you're going to live till 90 or 100, let's say 90, then your time horizon is 35 years. So a big chunk of your portfolio needs to be in stocks. And then still a big chunk of your portfolio you're going to need within the next 5 years, you're going to need annual income. So you've got to put it together to figure out what your holding periods are for each portion of your portfolio. And that's really how we come up with the asset allocations and the ability to take risk. But you want to match your holding period with your risk, and then that will dictate what your return can be. And then we just take it a step further and say, okay, well, stocks and bonds, and then also look at a 50% stocks and 50% bond portfolio. A 50% stock, 50% bond portfolio over a 5-year rolling period since 1950 never lost money. So that's a very good place to be when you're getting closer to retirement. If you've still got a long way till retirement, the higher returns, and you've got a 20-plus year time horizon before you need any of this money ever, then we can start talking about a majority of a stock portfolio. But when we're getting closer, 5 years or less, those returns that you get the 5 years before retirement and the 5 years after retirement are exponentially more important to you than any other returns you get over your lifetime of investing. It's because you've got a lot of money that's invested and you're going to start to use it. And so that's why they're proportionately more important to anyone who is retiring, that 5 years leading up to retirement, the 5 years starting retirement. Those are the most important 10 years you have. The performance of your portfolio will dictate how your retirement goes in those very important 10 years. So we need to make sure that we get those right. I was going to have this as a poll question, but believe it or not, even though we're up 5% on the S&P intra-year or year to date, we had earlier in the year the S&P 500 lost from peak to trough 10%. About late January, maybe January 26th to early February, we lost 10% on the S&P 500 in a very quick period of time. Those are normal things that happen in the market. You can see that, in the last 10 years, we've seen 28% pullback, 16, 19, 10, 6, 7, 12, 11, 3 last year. So no volatility last year. That's not normal. Normal is, yes, inside of any given year, we have some big pullbacks. We need to make sure that we have the correct portfolio so that we don't have to be selling assets at an inopportune time. If we had to sell assets in February, that was not a great time to be selling assets this year. And then take it kind of back further here, the asset allocation portfolio, which is just a combination of some of these asset classes, has earned us since 2003 about 8.3%, and it's one of the lowest volatilities on this chart. And we kind of have this chart here to show you that every year any asset class can be the top performer. We have emerging markets, the top performer for a couple of years, and then boom, it's the worst performer. And then the best performer, third best, worst, and so on and so forth. But if you look at the asset allocation model, it's never the best, it's never the worst. If you're a golfer, it's right down the middle of the fairway. And that's where we want to be with this asset allocation portfolio, especially the closer you get to retirement, because the mistakes that we make when we start pulling money out of a portfolio, the more they're magnified. We want to reduce negative outcomes the closer we get to retirement. With that said, we did do a rebalance about a month ago. We've overweighted small cap even more than we had. Developed international, we're overweight. Emerging markets, we're overweight. Once again, these are just mainly due to valuations, mainly due to where we see stocks going over the next 10 years, and then underweight fixed income with long duration. Obviously, we like shorter duration better because we believe that interest rates are going to go higher from here. As we get closer to about 3.5% to 4% on the 10-year Treasury, we'll start to increase the duration on our portfolio because we're actually getting paid to do so. But until we see about a 3.5% 10-year Treasury, we're still going to stick to shorter duration fixed income. Domestic equities, we pared back pretty significantly in this last rebalance. If we look at the top, if we look at the S&P 500, which is a market cap weighted, an average market cap weighted index, you can see that the top 5 companies represent about 12% of the index, and it's your Apple, it's your Amazon, it's your Facebook. These stocks, we believe that a lot of them are priced for perfection. It doesn't mean that they can't continue to go up. We've seen a couple of them do very, very well this past quarter with earnings, and we've seen a couple of them do very, very poorly. Facebook was down 20% after earnings were announced. So we just think that they're very well priced, and we see other opportunities. We've had a really good run there, and we want to make sure that that we don't get lulled into owning, you know, a couple of companies and then have something happen with the tech sector and have something happen with Apple and Amazon and Facebook, and be stuck with, you know, a big chunk of our portfolio in 5 stocks. So we definitely pared down our domestic and we pared down on some of our index stuff as well to get a little bit more small cap exposure and a little bit more diversification inside of our large cap names. Also, if we believe interest rates are increasing, that's not very good for REITs and it's not very good for utilities, so we have an underweight in both of those. So I've gone 10 minutes over. I'm going to go ahead and cut it there. And Nick, can you go ahead and give us questions?
Thanks, Sean. And as Sean mentioned, if anybody has any comments, questions, please feel free to share those with us via the GoToWebinar question box that's on your screen. And I do have one question here, Sean. This is kind of combining 2 macro variables to kind of figure out what the expected effects could be on U.S. market, and let me kind of go into some detail. So if we put any other macro variables aside and just focus on the U.S. Rising inflationary environment combined with the U.S. Rising interest rate environment that we're seeing here kind of converge, what could be the expected, I guess, combined or net effect of those 2 items on U.S. equity markets in terms of, you know, tailwinds or headwinds effects?
Well, inflation is generally, if we see higher inflation, it's generally positive for stock prices. It's generally positive for real assets, so real estate, commodities, stocks, and those are all inflation hedges inside the portfolio. If that causes the Fed to increase rates rapidly and then we get a recession, or people start to perceive, hey, the Fed has to increase rates too quickly and to try and keep up with this inflation, then that could be a headwind for stocks. So it really depends on on how fast the inflation goes and how it's perceived by the market.
Okay, well, we don't have any questions, so you know, as always, we invite anyone to email us later on after the webinar if you have things that you think about. That aside, I guess I'll give it back to you, Sean, for concluding comments and farewells.
Well, I appreciate everybody tuning in tonight, this afternoon. It looks like we actually have quite a few people on, so maybe this 4 o'clock time is a little bit better. If you have any questions, let your Ironwood advisor know, or shoot us an email. If you'd like us to discuss certain things in the future, please shoot myself or Nick an email to give us topics to go over. We're glad to input those into the future presentations. And then lastly, our next presentation, once again, will be the first Thursday in November. Whatever day that is, you'll get an invite, and we'll update these things, and hopefully we can talk about small caps and international and emerging markets doing well, and adding some returns to our portfolios. In the meantime, have a great rest of your summer, and we will talk to everyone soon. Take care.